Hi everyone, and welcome to part 2 of a video on how to review one's investment portfolio. In part 1 of the video, we looked at the first 4 steps, which included the importance of collating all investment related information, how to set up performance expectations, how to assess portfolio returns, and also how to tag and identify the right metrics. In this video, we continue from where we left off and now move on to step 5 of the process, which looks at how one can select the ideal funds for investing or retaining within one's portfolio. A large part of reviewing one's portfolio is to determine which assets or which funds have done well, and more importantly, which ones are likely to do well in the future. This is easier said than done, but an effective way of getting about this task is by creating a plan, a framework that can aid the selection, retention, and rejection of funds. Now, people tend to overcomplicate this part, so the best way to uncomplicate is by looking at the right signals. And there are only 4 that you need to look at. 1, the performance. 2, the consistency. Number 3 is volatility. And number 4 is the downside protection. So performance, consistency, volatility, and downside protection. If you can look at these 4 signals, it is our belief that your fund selection, fund retention, and fund rejection process will be top-notch. So let's understand performance first. Now, performance does not mean picking out the previous year's best fund. On our YouTube channel, we've explained the follies of that approach multiple times, and what we really need here is a filtering criteria, a signal that broadly explains good performance. For example, one of the ways of doing this would be to say that you are only interested in funds which are in quartile 1 or quartile 2 of the current performance listings. In other words, you're keen at looking at only those schemes that have performed above average. Similarly, you can develop criteria for other variables. For instance, in the case of consistency, you might want to look at funds that have spent at least 4 of the last 5 years in Q1 or Q2, but have never been in Q4 in any of the last 5 years. With volatility, you are obviously looking for below average volatility. So maybe you can define it as a standard deviation of less than 20. And in terms of downside protection, you may want to affix a minimum Sortino ratio of say 70% or 75%. So the point is there are choices that you need to make, and no one can really do this process for you, as each of us have a different portfolio, a different risk tolerance level, and different expectations. But hopefully the criteria-based filtering approach would have given you an idea of where to start and where you're trying to reach. Having said this, here are a couple of recommended practices. Tip number 1 is don't look at recent data, that is not the last 3 months, 6 months, or even 1 year, especially in the case of equity funds. In fact, with equities, your evaluation should be for at least a 3-year period and preferably 5 years. And tip number 2 is the key to good portfolio selection, retention, or rejection is not to look for individual keys in isolation, but to think of the process more as a combination lock with multiple variables that need to be considered. The fact remains, the more number of times you do step 4 and step 5 of the portfolio review, the easier this entire activity will become. But if you think all this is hard work, and honestly it is hard work, and that it is not your cup of tea, then probably you might want to move from investing via actively managed funds to more passively managed index funds. This will save you a lot of this effort of comparing, selecting, tracking, and periodically reviewing your choices. Once we are done with assessing the portfolio from a statistical angle, it's time to ask why. Why did your portfolio overperform or underperform? Or more specifically, why did certain schemes over or underperform? This question is more for investors in actively managed funds, and it requires a deeper understanding of what the fund manager has been buying and selling. It's not a difficult task, but it's definitely a time-consuming one. But once you get the hang of it, it can be a rather enjoyable thing to do. On the ETMONEY YouTube channel, we have not one but two videos where we have detailed out the portfolio construct of a particular scheme. These are the videos on why the equity schemes of Axis Mutual Fund are overperforming, and the other one is on why the equity schemes of HDFC mutual funds are underperforming. These videos are about 6 months old and do a wonderful job of asking why and applying context to a fund's over or underperformance. And once you understand this, you can look to do this exercise for other asset classes like gold, fixed deposits, PPF, etc. Of course, these assets will have their own peculiarities and their workings will be influenced by factors like the interest rate, bond yields, inflation, market liquidity, etc. In fact, a wonderful resource we'll recommend here is the India Economic Monitor, which is a monthly report on the Indian economy that is compiled by BCG. This report captures dozens of economic indicators such as industrial activity, trade, sentiments, sector trends, etc. And it's something that we also use internally as a part of our research process. Changing parts of your portfolio is important as it keeps your objective on track by making key adjustments. However, it's also true that investors are a restless lot and tend to tinker with their portfolio, which does a lot more harm than good. An effective way of making purposeful changes is to borrow some of the project management principles that are used in handling change requests and then applying it to our portfolio review practices. For instance, in project management, a change request process typically follows 5 steps and includes the gathering of support materials, the scoping of the change request, assigning a priority, making a go, no-go assessment, and finally deciding on the course of action. The same 5 steps would go very well with making portfolio changes, which in our case would be: step 1 is where we shall arrive at a numerical basis for the change. For example, will the change improve our portfolio performance by 1% or 11%? Step 2 will be about figuring out the impact of the change on other parts of the portfolio like the asset allocation, expected returns, changes in the risk profile, etc. Step 3 is where we want to know if what we are doing is a change or are we tinkering? That is this change really necessary? Step 4 is the go, no-go step where we determine if the change is within or outside the tolerance limit. And finally, step 5 are the set of tasks that one needs to do to effect these changes. For instance, what to buy, what to sell, what are the switches that need to be made, etc. From what we have seen and read, serious changes to one's portfolio should be done over the medium term, which is typically 3 to 4 years. So if you want to change the asset allocation, it's 3 to 4 years. If you want to stop an SIP, then have it for at least 3 to 4 years before taking any action. Of course, we all understand that this is easier said than done, and 3, 4, even a year can seem like an eternity in a world where investing apps, including ETMONEY, allow you to buy and sell in mere seconds, and it's probably why following a proper change methodology becomes all the more important. So say for example, you start seeing a problem with a fund which has a low alpha and a low Sharpe ratio. Now, as per your previously defined process, a low alpha, low Sharpe ratio is your trigger that warrants an examination of the fund. Now, instead of quickly opening up the app and tapping on the redeem button, we suggest you give yourself some time before acting on your observations. So if you're concerned about a fund, then put it on a watch list for the next 3 months and keep an eye on it to assess what is going wrong with that fund. Now, after 3 months, if you can't find anything wrong with the fund, then you might want to give it an additional 3 months or an additional 6 months. The point is never make changes with a short-term vision. Instead, be very intentional about making any changes to your portfolio and do that only after giving it enough thought and introspection. A portfolio review process should be more about direction rather than a rigid structure. And that's what this 8th and final step is all about. And while in an ideal world, it is good to do the review on a pre-assigned date, we still have to recognize the fact that there may be times when an ad hoc review is necessary. For instance, an ad hoc review is highly suggested when the stock markets have had a deep correction or when the stock market volatility falls outside your comfort zone. But before you do that, don't forget to define what a deep correction is for you. Is it a 20, 30 or a 40% drop in the stock markets? Or is it the default of a AAA rated corporate debt? Or is it a 50 basis point change in the RBI interest rate, etc.? So you definitely need to know the triggers before you can decide to act on one. A couple of suggestions here. Firstly, don't invoke a portfolio review when the markets are volatile. It is better for the storm to have passed and only post that should you do a review. And a second advice is to keep your tolerance limits a little broad. So don't say something like, I'll have a review if the equities fall by 5%. That's too narrow. And if you stick with this 5% variance, then you might end up doing a portfolio review every 2 weeks, which will dilute the activity's purpose and objectives. Beyond performance-related movements, an ad hoc portfolio review is also recommended at times of important life events like a change in your job or occupation, or if you're about to have a baby, or if you're changing cities, etc. These are important life changes and are good trigger points for a portfolio review. And with this, we close out the 8 important steps that one needs to follow when reviewing an investment portfolio. So to quickly summarize, here are those 8 steps. 1. Gather every piece of financial information and record it in one place. 2. Set your portfolio expectations from a returns and risk perspective. 3. Assess your portfolio returns. Point 4. Study your portfolio constituents from multiple perspectives, such as the core versus satellite approach, the right benchmarks, and of course track your alpha, beta, standard deviation and Sharpe ratio. Then comes point 5, which is about identifying the right signals to know which funds to buy, retain or sell. Point 6 was about applying context and doing a deep dive on why something happened or did not happen, which has the added benefit of making you a better investor. Number 7 was on how to go about the portfolio change process. And finally was step 8, which was on accommodating an ad hoc portfolio review if and when the situation demands it. Now, it's truly possible you are already doing a few of these steps here and there, but we sincerely hope this video has given you a structure on how you can conduct these portfolio reviews. So do try this out and do share your experiences and learnings of doing it in the comments box below. And if you're still not an ETMONEY user, then don't forget to download our app and access some of the wonderful tools we have discussed in part 1 and part 2 of this video. Do like this video, subscribe to the ETMONEY channel and share this video with your friends and colleagues. Thank you for your time and I look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.